Hello and welcome into the KE Report. Shad and Corey here as your host, and today we're talking with our friend John Rubino. John, you can follow him over at his Substack page, and we'll put a link to that down below so you can follow along with all the analysis on the resource sector, on the macroeconomic movers, geopolitics, and even dices in a little humor into the mix. And John, always great having you on the show to get your take on things. And I think we were talking off mic just that the backdrop that we're seeing now is a solid bull market in the precious metals sector. We're seeing gold prices hang there well above the 3,000 level in the 3,200s, 3,300s. That's giving producers and royalty companies fantastic margins. It's revaluing the way people look at development projects in the gold equities. We even have silver starting to play a little catch up and some of the silver equities kicking in gear. So overall, a really solid environment to be in the precious metals sector. And I just wondered what your take is on either that part of the dynamics or some of the macroeconomic movers that are keeping precious metals well bid.
Hey Corey, hey Shad. Well, my main take on it is that it's about damn time. So this is happening as it should have, but it's 5 years late. But I'll take it. And let's start with the gold miners first as a story related to the gold price, because we're in the process of finishing the first month of the second quarter, and gold is holding above $3,000 an ounce, which means the miners, 1/3 of their next quarter is over, and they generated really good numbers for that 1 month. And if it continues, if gold stays at its current price for the next 2 months, then we'll have another set of blowout earnings reports for the second quarter. And I think decent possibility of that happening, which is just great for the miners operationally and in terms of their equity value.
John, what do you think about this rotation of money that we've seen, though? As much as these miners continue to make money, most of them have been running for a little while, but now we're starting to see maybe a slowdown in some of the momentum of the major miners and a filtering of money down to more of the mid tiers and even down to the juniors. A lot of positive moves in a lot of junior stocks.
Well, that is the way it normally works. When there's the beginning of a gold bull market, people go to their financial advisors and say, get me some gold stocks. And so the financial advisor, who probably doesn't know anything about gold stocks, just looks them up and buys some Newmont and some Barrick. And those tend to go up first. But then the gap in terms of every valuation measure that you can think of between the big guys and the smaller players starts to widen so much that a lot of generalist money starts flowing downward through the food chain. And eventually you get to the point where the junior miners start being taken out, and then the explorers start behaving kind of like dot-coms for a while, where anything with gold and silver in the name catches a bid. And we're very early in that process because a lot of some of the explorers have done very well lately, but a lot haven't. So the money coming in isn't yet indiscriminate. And that's kind of how you know when you're getting towards the end of the process, is when bad names, companies that you would definitely not invest in, start going up just as much as the good names. We're nowhere near that yet. So, history says that where we are right now is maybe 3 or 4 years from the peak in the cycle. So it's still a good time to buy the big miners because they're reporting really good year-over-year comparisons. But it's becoming a good time to start looking at the high quality junior producers and then the really good explorers. And a couple of years from now, it's going to be a great time to be buying those things. But right now, it's a good time to get into them. So it's nice to be kind of conscious of the process and be early in a cycle like this, because based on the past couple, a lot of fun times are coming for early investors in precious metal stocks, of which we are, right, guys? So this could be a lot of fun going forward, and it could run for a while from here.
Well, John, just to that point of it continuing to run for a while, we're hearing a lot of chatter about people that are already pulling some profits in the producers, the larger senior and mid tiers that have really run, because some of them are up substantially. They're up multiple fold. So people are pulling profits in those to start rotating it down the food chain. But if this keeps going for a long time, it also begs the question, should people be selling the quality and rotating down into lower quality at this point in the cycle? Because maybe the big stocks keep running and maybe generalists keep finding those and noticing their earnings potential too big to ignore. Maybe it's too early to be rotating down the food chain, or do you think it's time, or is that just the natural cycle of it that some early stage investors rotate down while new investors flood into the larger cap companies?
Well, it depends on your risk tolerance. If you really don't want to deal with extreme volatility, then you can stay with Franco-Nevada and Newmont and Agnico Eagle and probably do just fine going forward. If you want to try for a five bagger, of which those big guys are not, unless we have a $10,000 gold price at some point. There are a lot of high quality names that you can get into that aren't crazy risky, but have a chance to go up a lot more. So there are people probably making that decision right now where, okay, my Newmont is up by 50%. Let me cash out part of that and get into, Equinox Gold or somebody like that who is a producer, but or maybe even an Alamos Gold, which is kind of halfway between mid-tier and senior right now. There are good names you can switch into without dramatically increasing your risk profile, but in the process giving yourself higher upside. So there's action like that out there. But I think if you have some large cap miners, you shouldn't feel compelled to bail and move down the food chain because the big guys will still do fine for a while in the scenario of gold maintaining its current price or maybe going up a little bit from here. So this is one of those situations, early in a bull market, it's hard to be wrong. As long as you're in that market, you're going to be making money as long as the underlying fundamentals stay strong. So, I have a spectrum of mining stocks. I've got a lot of the big guys and a lot of mid tiers, especially in the royalty streaming space, and then a lot of what I'm hoping are high quality explorers. And the expectation is that if gold stays at 3,000 or above, that all of these guys do pretty well as groups. And a few of them will do great, a few of them will fail, but most of them will do pretty well. And I don't feel any real compulsion to jump in with both feet into, for instance, the explorer space right now. But I think the time will come, when the gap between the mid tiers that are being bought out at really nice premiums and explorers with similar high quality resources that just haven't been turned into mines yet, when that gap becomes immense, then you really want to load up on the explorers because they're, at that point, they're still going to be five baggers and maybe the really best situations, 10 baggers. And you only need a few of those to change your financial life. So there's no reason to be one-sided about any of this. Everything is doing fine right now, operationally and financially, and that'll probably translate into nice stock price action going forward for whatever you're in.
John, I'm with you, but especially in the sense that I want to keep seeing these majors and these high quality companies continue to run higher. And fine, that gap can even widen. But I do get sometimes a little worried if the juniors really start playing catch up and we don't see that price appreciation in some of the majors and the higher quality companies. But hey, those ones have moved so much recently. What's your take on these projects, these companies that have projects that are kind of long in the tooth? They're old projects. They've been around for a while, but they have massive resources. Now that pretty much literally every project that has a resource makes money at these prices, what's your thought on buying some of these assets, buying some of these companies that, again, have this big resource that now looks like it makes money?
Well, yeah, I mean, most of the operating mines that are out there right now were greenlit at an assumption of $1,200 to $1,800 an ounce gold. So unless they have some kind of an operating problem, they're much more profitable now than they were a year or two ago. So big resources, for instance, let's use maybe Seabridge as an example, where they just have a massive resource of gold and copper. And they've never been able to find a joint venture partner that wants to go in with them because of the expense of ramping up mines that would be as big as what Seabridge can justify. And their chances, although they've got some issues with with local communities that have to be sorted out, but somebody like that has a huge resource that hasn't been exploited yet just became a lot more valuable at least in theory, because the ounces that they take out of the ground are now worth an extra, $1,000 each or whatever. So situations like that, to the extent that they were ever valuable, just became a lot more valuable. And that's true also for the big producers because they've got presumably a lot of gold and silver in the ground. And all of that has to be revalued at today's higher prices. So, yeah, just pretty much anybody in this space got a lot more valuable in the last year because basically think of them as like vaults where there are gold bars stacked. And they sell those gold bars at whatever price the market will bear. And when the market gets happier and is willing to pay more, the contents of that vault becomes a lot more valuable. So that's where the gold mining sector at least is right now. And it's kind of an embarrassment of riches from the point of view of an investor. It's actually kind of stressful from the point of view of an investor too, because there's a lot of good ideas out there, a lot of situations that just look really ripe for revaluation. And it's not easy to decide among them unless you have unlimited cash to throw at the whole sectors. So, in a situation like that, by which I mean limited cash, if you can only buy a few things, as always, you should go for quality. So learn about the situations, watch shows like yours and hear what the CEOs have to say, and make your list of the really, really good names that are relatively low risk and potentially really high value, and then focus on them. Rick Rule says something when he asks people to send in their portfolios and he'll grade the portfolios for them. And he says the biggest problem that he sees is people with too many names because they can't possibly keep track of 30 different stocks, especially if half of them are, in some kind of junior or explorer category. So limit yourself to the names that you can keep track of and that you feel like you understand and go for quality and you'll be fine right now. And then with money that's left over, take some chances. There's always a time when lottery tickets can be justified. And this is one of the better times, though, when there's a lot of potential 10 baggers out there that haven't really moved yet. And looking for those is also a really fun thing to do in this kind of market.
Well, John, just honing in on the topic of buying quality, I find quality to be like the word beauty. It's very subjective. It's beauty's in the eye of the beholder, and I often think that quality is on the eye of the beholder depending on who you talk to. There's certain people that love a certain project, and you'll talk to another investor and they hate that very same project. You brought up Seabridge, and it makes me think of these companies that have been on the sales rack for the last two cycles and nobody's built them yet. Not just Seabridge, but think about International Tower Hill Mines that has about 14 million ounces of gold. Or look at the deal we just saw with Paulson, where they came in and got Barrick's half of Donlin Creek, held mostly by Nova Gold too. That thing has been out there since I remember in 2010 and 2011, where Kramer was on TV talking about how he's putting his kids' retirement in there because they have so much gold it's going to get built. Some of these things haven't been built for 2 decades. So are they quality? I mean, we could say that they are on paper, but sometimes these things have jurisdictional issues. Certain companies have a lot of ounces in the ground and they look like quality on paper, but they're not getting built. They're not getting bought out by larger companies. So how do you filter down to decide what quality even is?
Well, see, that's part of why you don't want too many names in your portfolio because it's not a simple thing to understand these situations. And if you're looking at 30 different positions, there's no way you can do the due diligence to actually understand all the different moving parts in a story. And, I totally hear what you're saying, that if something hasn't attracted a buyer in 20 years, why should it ever attract a buyer? And in some cases, that's going to be true. That there's just a fatal flaw in this property and, it's never going to be able to be made to work. But there's another category of things that look kind of similar to that, where it was a valuation issue. It was expensive to build the mine because it's so out of the way, or because we're talking about such a big resource that you need massive mill capacity and stuff like that. And the price of the metal never justified that expense. But, you let the metal go up by 50%. And all of a sudden, there's one subsection of this group that moves into the doable category. And because nobody's paying attention to them because they've been sitting around for 20 years, you have a lot of upside potential. And, I think that's an interesting play, but I don't always feel technically competent to make the decision, to judge something like that, because like you said, there's so many different parts to the story. But I think if you're capable of it and you're willing to put the time into understanding some of these things, then that's a category where there are 10 baggers. That's a category where there's some stocks that are going to be revalued when some seniors come in and do some due diligence and conclude that they're really undervalued based on, a projection of 3 years in the future gold price or something like that. So, like I said, there's a lot of different categories out there that have great stories conceptually, and you just have to be able to pick the wheat from the chaff in each category to really be successful as a stock picker in the mining space in general and the junior mining space in particular. So it's hard, but it's also a lot of fun because once you've had a Great Bear Resources that you got in early and rode all the way up to the 40 times its original price buyout or whatever that turned out to be, you know what that feels like. And so you're motivated to do a little bit of extra work to find the next one. And in this market, there are quite a few out there right now, thanks to $3,000 an ounce gold. So, it's a fun time, stressful time, but a fun time.
Oh, that's the thing, John. $3,000 gold, man, it makes everything look profitable. But then the big question being, and kind of what you alluded to there, is where's the money going to come from to actually build these things? These assets can still sit on the shelf and can do well in this sort of bullish environment where a lot of stock prices move higher simply because the metals price is higher. But the big question is, where's the money coming from and where is even the human capital coming from to get these assets built? Do you have any insights on what we could see, what you think is actually reasonable in terms of, yes, the M&A front, but then also the capital being put to work to build these mines?
Well, the human capital is actually a much bigger impediment, I think, now than financial capital because not that many engineering students went into mining engineering in the last 20 or so years. So you got a whole generation of 60-year-old mining engineers who are retiring either now or in the not too distant future. And it doesn't look like there's a pipeline big enough to replace all of them. And that's a real problem that raises costs and limits the technical success of a lot of mines. So yeah, I don't have a good answer for that. That's a serious problem. But it's not like there's nobody in the space. There are no engineers. They're out there, but there's probably kind of going to be a bidding war, or there probably is now a bidding war going on. And that's tough for a junior miner. If Newmont can come in and pay whatever it takes to get your best engineer, then turning a resource into a mine gets much harder for you because you don't have the talent maybe to do it. So yeah, that's an issue. But for financial capital, that's getting a lot easier because the big producers are generating massive amounts of cash flow right now. So yeah, they can pay off all their debt, then they can raise their dividend, and then they can buy back some of their stock. But they're going to look at their resources and think, well, okay, we're running through it faster than we should. We're going to need to find more ounces out there somewhere. And they've got a suddenly surprising amount of cash to throw at that project. So they could go to somebody that has a big but potentially high cost resource, and they could run the numbers using $3,000 an ounce gold and go, okay, we could throw $1 billion at turning this into a mine. Whereas 2 years ago, they never would have even conceived of doing that. And so I think that makes it a lot easier. And plus, you got to include human nature into this equation because if you're the CEO of a good sized miner and suddenly you're generating massive cash flow, you start thinking about empire building. And it's not just maintaining your reserves, but you want to go out and maybe double or triple your size by the time you're gone, and then everybody's going to be hailing you as this genius empire builder, and suddenly that starts to sound not crazy anymore, and so some big deals become possible because of your ego that maybe even aren't justified financially right now, but they're almost justified financially. So all you need to do is think, all right, not $3,000 an ounce gold, but $4,000 an ounce gold, which is completely possible, given the BRICS and given Basel III and everything, and maybe even Trump going back to a gold standard. You can spin a lot of scenarios in which $4,000 an ounce gold becomes possible once it's blown through $3,000. And that makes all kinds of things conceivable if you're a CEO of a producing miner that suddenly has twice as much cash flow as you've ever had in your life. So towards the end of the cycle, we'll probably see a lot of stuff like that. And a lot of mines being greenlit that maybe don't seem reasonable or didn't seem reasonable at $2,000 an ounce. So the question is, which ones? Will it be a Seabridge, or is it somebody whose name that I don't know yet? And we'll have to see about that.
Yeah, John, that's the treasure hunt part of this business where you want to get positioned in the companies that you think are the takeover candidates so that you're part of those empire building regiments when they get going and that they take over your junior stock and
Yeah.
and you get that nice premium. But you brought up an interesting point about some of the macro factors that may underpin higher prices. A lot of people feel like we're kind of stagnant here with gold, which is fine at these prices. They're very high historically, great margins. But what could some of the factors be that drive the gold price higher? You brought up Basel III. That news has been circulating. We're seeing a lot of stuff going on with the BRICS. You brought that up. What do you think the main drivers are for higher metals prices?
Well, the first and by far the biggest is excess debt. Every major country is just borrowing like crazy. And they're just now kind of entering a financial death spiral where the interest cost on a government's debt is spiking. And that money has to be borrowed, which raises next year's deficit and next year's interest costs and so on until things just spin out of control. That we've entered that phase now with the US and Japan and a bunch of European countries seeing really massive interest cost expense increases. So no matter what else is going on in the world, the fact that we're screwing up our finances on such a massive scale is going to force central banks to try to bail their governments out. And that's going to be very good for precious metals. So that's there, and that is unchangeable. It's baked into the cake. But in the shorter run, you got the Basel III thing where they're changing the regulations that apply to gold for banks, and gold is moving from being an asset that you have to reserve against to the reserves. Now you reserve against other things with your gold, and that makes gold a lot more useful for a bank. So banks presumably are adding to their gold reserves in order to diversify beyond just dollar denominated debt. And they're not super price sensitive, apparently. They're probably making a decision. Okay, we need this mix in our tier one assets. We don't have enough gold yet to achieve that mix, so we need to go out and get gold. So that's probably happening. Then you got the BRICS countries that, I'm not sure how much their attitude has changed with Trump in office. It may be that they're a little bit less worried about the US using the dollar as a weapon, or maybe because of the tariffs and things, they're more worried now. But in any event, BRICS central banks have been buying a lot of gold over the past few years in order to protect themselves and maybe bypass the dollar altogether in bilateral and multilateral trade. And it looks like they're still buying. China just released a big number that its imports through Hong Kong were much higher than expected or something like that. So it could be that they're still buying. And they're not super price sensitive either, because for them, it's a geopolitical issue. It's not, oh, I'm going to invest in this thing and I hope to get a 20% return. They're thinking, if we have a trade war with the United States, we don't want it to turn into a shooting war. And how are we going to protect ourselves? So you got these guys who aren't super price sensitive who are buying out there. And then you have retail investing, which, for instance, at Costco right now, they just reported that they've been selling gold and silver bars, and they just had to scale back. They had to lower the limits of the number of bars of gold that customers are allowed to buy at one session, one visit, and in one 24-hour period, because demand was too strong for supply. So there's an element of retail investing coming into the gold market now too, that's not unusual. When the price of something starts going up, people who weren't paying attention get excited. If they don't completely know the story, they still see that shiny thing moving, and they buy. Look at Nvidia's stock or something like that. Nobody understands Nvidia. or 1/10 of the buyers of its stock actually understand what it does and what the issues are. But it's rocketing, so they buy it, And the same thing could be happening at the retail level for gold, which would be pretty cool. Not crazy surprising, but cool to have happen. It would support the price of gold going forward. And it would rocket silver if it happens, because when gold attracts a lot of retail investors, those same people sometimes look at silver and go, "Oh, look how many silver ounces I get for 1 Krugerrand. Maybe I'll just buy silver." And so then silver gets swept up in the gold thing. So we're kind of there. The Basel III thing and the BRICS thing and Costco are all kind of new factors. But however you buy your gold and whatever your reasoning is, once it starts moving, it gets people excited, and that generates buying just in and of itself. So we're there. We've got some new issues, some traditional issues in the gold market, but they all kind of point towards a stable to higher price going forward.
Well, stable to higher prices going forward sound good to me, and they sound good, I'm sure, to people listening in that have a portfolio of precious metal stocks. Also, the point you made about silver eventually playing catch up. Poor man's gold when people start buying more silver, and when they find the silver stocks, very tiny sectors. So just some of that capital pouring in can really move those in a dramatic sense. So we'll keep following along with all of the movements and gyrations and news in the precious metal sector. Appreciate you weighing in on portfolio management, John, and the kind of stocks that have your attention and where you think things will develop in the gold equities. And for people listening in, if you like getting John's thoughts, definitely click on the link down in the show notes to his Substack page. John puts out interesting information every day. A lot of it, again, is on the macro side of things, on geopolitics, but he does get into it for his paid subscribers, what he's doing in his own portfolio, and he's done a very good job of curating a good list of different stage companies to access different sectors within the precious metal space. So, John, always appreciate having you on the KE Report and looking forward to our next conversation.
Thanks, guys. Looking forward to it too.